Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn with Focus Compounding, on air live with Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content that we push out into the investing universe. Best way to do that is to follow me on X at @FocusedCompound. You can also get access to investment write-ups from Geoff going all the way back to 2005 by going to focuscompound.com. All the information is in the description below, and everything is available for free. So in today's podcast, Geoff, we're going to talk about what's been going on in M&A land lately. We've been following the Spirit Airlines merger for quite some time now, and news came out, and the stock took a hit. The judge blocked it.
Yeah, we should explain the day that we're recording this because I think it went up a lot from its low.
Yeah, so today's January 19th.
Okay. So you'll see a stock symbol there and stuff that shows up a lot, but obviously it dropped a lot before then, and that was because people were hoping, although there was a huge spread on it, that the deal would close, and it will not now. Yeah. And there were reports that they were considering things like liquidation and stuff of the company.
Do you think just staying away from airlines forever is just a good like tenet to have in your investing thing? Just don't even go near it, Just the amount of capital that has been lost by investors in airlines, it's got to be a lot,
Yeah. Yeah, it is. There's a reason why some of these things were looking to merge, and so some of them are weaker, and that's why. I also don't know if some of the announcements and rumors and whatever had other purposes. I think that they probably may have, like in the case of both companies, JetBlue and Spirit. And then later news was different. So some of it may have been intended to show the government and stuff that this is what happens if you do this. You block the deal and then the airline's going to go out of business. You block the deal and then we're going to cut a lot of routes and stuff. And that's why we needed to merge. So it's possible. I mean, certainly they would have waited till after the case for that stuff to leak out or to say it.
So what's going to happen then? I mean, do you think Spirit will actually go into have severe financial difficulty, and then JetBlue is going to pick them up in chapter whatever? I mean, what's going to happen here? I mean, I don't know. Like, I thought about that, like the irony of, blocking it, killing Spirit's business. They're going to cancel routes, lay off people, cause financial difficulties. And then what, right? Is JetBlue going to just buy them then? I mean, what do you think?
Well, the government has a history of doing this lately. There was a blocking of a merger between two office supply stores. There was blocking of a merger between two satellite TV operators. There's blocking of those obviously don't look as good because there was tons of competition, and they would have been better off if they'd let those things merge. Mm-hmm. But they have the rules that they have, and they basically apply those without a lot. I mean, when it actually goes to a court case and stuff, without a lot of thinking on the long-term consequences and stuff. So it's just how they choose to measure things like market share stuff, and especially things like I think they put a lot of effort into the overlapping routes, and if the price would increase. I don't know if that's the most important thing in the world to the country and stuff, but I think that's what the case cares a lot about and stuff. And maybe doesn't care as much about other aspects of service besides price, or other things like over the entire network and stuff, what it would mean. So it wouldn't be, it wouldn't be the first time. And also, I mean, so there are ones that have, a lot of these have happened eventually. So satellite TV was one that I mentioned, blocked, but then, happened eventually. And then you also had a wireless carrier merger of like the fourth place one. So that was, something that some people oppose and stuff, but was allowed to happen. And that's another one where at some point they go out of business if you didn't let them merge. We talked about this when we talked about like the way that the airline industry is now versus in the past. My honest feeling is that it's very hard to have a low-cost airline now. It's much harder to compete with the legacy ones, especially if we count Southwest as like a major airline, even though they're not originally a legacy one. They're a lot like the legacy carriers now. And they have so much in their advantages versus you that I don't know if it would be as easy to create a JetBlue or a Spirit or a Southwest today, or if they would be that successful, or even if the ones that exist, JetBlue's not really a low-cost carrier exactly, but the ones that exist will have a good future. So, but we'll see. I mean, JetBlue, I don't think, for instance, I'm not an expert on airline stuff, but I have read whatever's been published on Southwest. I've read the books that are published on JetBlue, listened to things by the founder of that company and stuff. I think Southwest had a much better business model. I don't think JetBlue's business model was ever that amazing. I think they just had like the most amazing operator for systems and processes. Like they had we talk about Henry Singleton, or we talk about Cap Cities or whatever. They had that, and that's what made JetBlue, I think, not the idea that they had, because it wasn't a particularly brilliant idea, and I don't think it's a great idea for the long-term future as compared to Southwest. Spirit, I don't know. It's not a time that was as good as when Southwest was getting started. I don't know if their ideas make as much sense either. So,
what about Hawaiian Holdings? So there's a merger expected to close in 12 to 18 months for a closing value of $1.19 billion. Upon completion of the merger, shareholders will receive $18 per share in cash, and that's with Alaska Air Group, Alaskan Airlines. And Hawaiian Holdings currently is trading at $13.91. So that's a pretty decent merger arbitrage spread.
Yeah.
You got it's an annualized return that's being calculated by Inside Arbitrage of about 20%.
Okay. It is, however, at a big premium over where it was trading before, because Hawaiian was the cheapest, by far the cheapest airline in the United States, or at least of airlines that I know of. I mean, there's what's the official name of Wisconsin Air? And
Harbor Diversified.
Harbor Diversified. I don't know about those things that are like I mean, that's Pabrai was in stocks like that before at one time too, right? I think he was. So, the Wisconsin Air one, it's called Harbor Diversified, right?
Yeah.
So it just, so it just has an agreement in place to basically supply passengers for a major airline. It's switch which airline it is, but they feed the passengers in for them, and that's how they make their money. They're not exposed in the same way as other people to the real dynamics of the industry. So it's just basically a way for a major airline to secure passengers, let's say in Chicago, from Wisconsin. And they switched who it is, but it just switched from one of the big four to another one of the big four. So I mean, that one's interesting because like I saw people doing like liquidation analysis of it and stuff, and I looked at it, and like I said, I'm not an expert in airline things, so I might come to a different conclusion that's very wrong, but my interpretation is that the planes are worth less than nothing. They're very inefficient. They weren't originally meant to be commercial passenger service. They were, the hope when that plane was created was that it was going to be used for business, private, and then it was changed over to be used for commercial airline stuff. I think they stopped making them 25 years ago, and I think they're expensive and inefficient and stuff to operate. They have gates, and they have scale in that they're going to sign one agreement. They're not going to split who they're signed with. So if Delta loses them to United, whatever, they can bring everything over to one or the other. It's like having to me, it's more like that they own a tower, and they're saying, we've got room for, in that case, you might say we've got room for, a Verizon or an AT&T or whatever. But if someone doesn't take it, then there's no room for, you the third one or whatever. And so that's, to me, more what that business looks like. And I wouldn't look at it on the basis of like liquidating and stuff. So anyway, the point with Hawaiian is it was in really bad shape. And if the deal falls through for any reason, you'll lose a lot of money because it presumably fall at least to the price it was at before, which was very cheap. But
in the floors.
Hawaiian, yeah, but it had been a lot higher before, and this was a company that earned a lot of money in the past. But it was in a fare war with that it could never hope to win if the other company stayed in it, with Southwest. So Southwest decided it was going to enter the Hawaiian market. And for instance, I use Love Airport, and so they have had a billboard there, of how cheap it is to fly to Hawaii and stuff. And so they decided to make that their entry into it. And in their history and stuff, Southwest has certainly tried to go into some places and then backed off when it didn't work. But they also have a history, certainly early in their company's history, of really hitting a place hard and taking a lot of the market share fast. And Southwest has tremendous financial strength. Hawaiian doesn't. Southwest has tremendous diversification. Hawaiian doesn't. So if their goal was really to like put them out of business, then certainly they could accomplish that. They say that it's also that passenger traffic from Japan hasn't improved, and that's an important part of their business, obviously. Since COVID, Japan hasn't bounced back the same way that other things have, and Japan's huge for the tourism in Hawaii. But the thing with Hawaiian that was always interesting to me is you would just wake up one day and it would be over. You just the stock would go flying up because someone would see that Southwest the fares were no longer putting up cheap fares and stuff, and they were giving up. So anyway, but there's like no chance that deal wouldn't happen if the things that we're talking about in terms of how the government looks at this, because the overlap's like nothing. It just wouldn't bother them. So presumably, I don't know what would happen, how expensive it is to terminate the deal for, without a reason like an antitrust reason. So the probability of the deal not going through is very small, presumably. Certainly it wouldn't be blocked for antitrust. People don't expect that. But the decline in the stock might be very large if it was not to go through.
Which is a merger arb situation you wouldn't be interested in. You have said the ones
that
you would be interested in are where you would be okay buying it, even if it didn't go through.
Like Albertsons.
Yeah.
Yeah, Albertsons I like a lot better, like as that kind of thing. Now, if you do all these, a lot of times they don't fall through and it works. And that's the actual game of it with the arbitrage. It's not really that important about the underlying stock.
Mm-hmm. A lot of these spreads are pretty wide that we're talking about. You have
very wide
Spirit, obviously. I mean, how much, what are the odds that Frontier comes and starts poking their head around to do something with Spirit or whatever? Or is that just completely dead right now because it was blocked by JetBlue or by
well, that's why
antitrust.
They said not to go with JetBlue. I mean, they said the company's own management stuff said you need to not take the higher offer of JetBlue because you will not get approved. The deal will fall through. The other deal is more certain. Take less money for the sure thing.
Yeah.
And they were right. Now, we don't know that the deal would have been approved the other way, but they were right. But, the interesting thing is who actually was in it before that deal and who's still in it. That's the thing. These airlines don't have long-term shareholders. So it is funny, in a sense, so you could say, oh, well, the shareholders should have taken the other deal. But who I mean, the Spirit thing's been going on for what? We're talking about
years now.
Yeah. So what, who people rent the stocks, right? They don't stay in them that way. And I don't think that a lot of people would have been in it to vote on the deal and stayed with it to now. What happened is these are just arbitrage that are in it. That's it. And so it is funny. So like their decision to go ahead with that. Now, they never got full value for their stock if they sold out, though, because the spread was big. But at times the spread was a lot smaller. So some people might have sold out and gotten pretty good, but obviously no one ever got the price that was promised. But their decision to do that really hurt people who are in the arbitrage things more than it necessarily hurt themselves. Although, like I said, maybe they would have gotten a tight spread in the other case.
Mm-hmm. Mm-hmm. What's this? MIXT? Is that Mixed Telematics? Powerfleet Inc. Mm-hmm. Looks like the spread on that is also pretty big. It's a stock deal, though.
It's a stock deal, yeah.
Expected to close in the first quarter of 2024 for a closing value of $140 million in an all-stock deal.
Right. I don't want to sound too negative here, but there's a few reasons why the spreads on things are wide.
Yeah.
Sometimes it's because there's a chance the deal will fall through and stuff.
Sure,
but
yeah.
on particularly very stale deals, what was happening in the case of Spirit, for instance, is you notice the stock would sometimes go down when the airline business was going down and things, not just when there was fear about the antitrust, because they start to be concerned of what happens, how far can the stock drop.
Yeah.
The floor that you were promised, if you're thinking that it's only going to drop to what the stock was at before the deal, which is a reasonable thing to expect with good businesses, right? Like it's in play and everything, so why would it be lower than that? But if the business has deteriorated a lot, then the price might be lower. So you saw that with the bank deal that fell apart. It was a huge decline, but that's because there had been a banking crisis basically in the middle of the deal being out there, you know? And so same thing with the airlines. If those deals fall apart, it could be a lot worse. So I don't know if that's a factor with Mixed Telematics. But it's obviously a super cyclical business, or I would say it is.
The Albertsons and Kroger deal, analyzed return 121%. It's a pretty wide spread as well. This is a company you'd feel comfortable owning if it doesn't go through.
Yeah. Yeah, and it's not for any math reasons. Here's my feeling on it. I think... Buffett didn't stick in with Activision to the end. But, he said Microsoft's got the cash. The companies want to do this. He knows, like, the people involved and stuff. And Activision would basically have been in play because, remember, there was the sexual harassment things. And it was a company that hadn't had different leaders for 30 years or something. So, realistically, although they don't say this, they probably were thinking about selling the company and resolving that issue anyway. Like, once that was happening. So... It was Activision was not a cheap stock when the offer was made, and the offer was not cheap, but all the other factors involved were good. Kroger really wants to do the deal, and will make. That doesn't mean that it'll get approval to do it, but they're willing to do all sorts of things, compromise on all sorts of stuff, sell off more stores, and they said do this, do that. They're willing to do anything to get the deal done. Sort of like Microsoft really wanted the Activision deal done. And Albertsons, I think their shareholders, like the key people there, I think are very likely to pursue other deals to sell the company or do something with it if this one falls apart. So I think you have a buyer that's very eager to buy, a seller that's very eager to sell. And then I think if we look at the QuickFS stuff, I think you have a pretty nice underlying business and price and stuff that you were getting. Unlike some other ones, I don't think this is a crazy price. Now, the airline deals, I don't think were crazy prices for those airlines. But, take Activision, take iRobot, those things, those are high multiples and everything for the stocks that those companies are offering. So when you tell them you have to now make compromises or you have to do whatever, then they're a lot more likely to say, oh, well, it's not that great a deal anyway, so, we're not going to do that. But if it's the deal of a lifetime, then you're more likely to compromise and everything. So, I like things where I think if the deal falls apart, you're still in pretty good shape with it. So, I think I think Albertsons is in play, and I think that it's pretty, but what are the price things on it right now that you've got? So the deal's a little complicated, right? But what's the price that's promised on it? Yeah, the spread, the chart there.
Yeah,
if you go to the inside arbitrage, we can just use what they calculated it as.
Okay, so they have the closing price, $27.25.
Okay.
Estimate closing 3/31/2024.
Okay, well that's not important because they keep bumping that and everything.
Yeah.
But let's use what's the current stock price at?
$21.99.
Okay. So what we can do is we can apply that kind of thing to the price things that you see there to get an idea of what the multiples are on the actual deal. So the actual deal price that you have is only about 25% higher than that. Now, it's not as good for Kroger because there's things in that Kroger has to give up if they were hoping to actually close this deal. But that's not so important to us as to say, well, how big a price is this anyway? Could someone else match it? Whatever. So what do we have for like EV to EBITDA, price to earnings, price to book?
EV to EBITDA 4.5, price to earnings 9.3, price to book 5.0, but price to sales 0.2.
Okay. So price to sales is not super cheap. Its margins have gotten way better, right, in the last few years?
Yeah, correct. Mm-hmm.
Yeah, so earnings are huge since like COVID happened, basically. It's very expensive versus pre-COVID, right? What was pre-COVID earnings? What was operating profit? Let's just say that.
Operating profit was, I'll read on from 2017 onwards, 608 million, 152 million, 622 million, but it's gone up. So 2020, 952 million, 2021, 1.6 billion, 2022, 2.5, and then 2023, 2.2 billion.
Yeah, so you have no protection back to pre-COVID things because the business was the company itself has also been improving its operations and everything at the same time that you then had the COVID bump. Because basically it's an LBO. So that's why you're seeing weird things with price to book and all of that. There are perhaps cheaper supermarkets out there, and there perhaps some better, better by the numbers in terms of quality, but nothing of this scale. Yeah, we talked about Village or Angles Market or any of those. The Village is quite cheap, but can't really be bought. I mean, family controlled, and you can't just buy it to become a member of the co-op and everything. So, like Kroger's not in New Jersey, and Village is all in New Jersey. And Village has been going in the wrong direction. They've been buying stores, and they're going the opposite direction of Albertsons generally. Like, right, their margins have actually come down until real recently. The underlying efficiency of the business was getting worse. Now, COVID bumped it up, I think, in the most recent year, right? This past fiscal year and guidance, I think, or they don't exactly guide, but this past fiscal year and likely the upcoming one will be good in terms of metrics. But yeah, I like it if you're buying in at a price that's 5 times EBITDA or something for something that's in play and that is financially solid and stuff. Yeah, I like that a lot better. The problems with the airlines is like the Hawaiian one. It has a really high chance of closing, but if it doesn't close, the floor could be low.
Mm-hmm. Yeah, there's a lot of risk there to wake up one morning and have a Spirit Airlines situation where the stock is just crashing, right?
Right. And Spirit, you had a pretty big spread and everything. So it's not just the probability of whether it will close or not. It's also like how much you'd be willing to, how much does it hurt to keep holding it? Do you like the stock anyway?
Yeah. Like what would you do in Spirit right now? Like, what do you do now? I mean, now there's concerns about their, even solvency or how they're going to do. It's now becoming this huge operational issue. What would you do if you were a shareholder? I mean, if you bought it on the premise of merger arb, you should probably just sell, right? But if you're using your framework, go ahead.
I don't think the information we're getting on Spirit is reliable, right? Because if you think about it, the shareholder base is all arbs who are selling out and stuff. There'd be people interested in shorting it because of these things that are going on with it. The company themselves is not reliable in what they're doing because they're saying we still want this deal to go through. We're fighting with the government. So their stuff is for show to show the government what's happening. So I think that it's much less reliable, the information that we have, and to understand what those signals actually mean. So I wouldn't be surprised if you get unreliable rumors and reports and things because everyone is probably trying to push things about the story so that the case can work out a certain way and so that the stock can too. right? Whereas if that wasn't the case, then it might not matter as much. So I would be cautious about that. The downside is zero. So, I mean, but yeah, I mean, yesterday or whatever, I got to say, it was at a price that, I mean, it would depend on, I'm sure people could buy options and different things and do whatever stuff to do things to protect themselves other ways. But there is a point at which, you know how far it can drop. And there's a ton of scenarios in which it could go up by as much as it could drop. If this was a $5 stock, there's scenarios where it could be worth $10. So if it's 50-50, it's not as crazy as you might think. When people are very sure that the deal is not going to happen, whatever, sometimes there's a big spread. But also what can happen is sometimes when people feel very sure that they don't see any way that things could get better for the company, you get a stock that goes too close to zero. And you have to remember that there couldn't still be strategic value to these things. And there are companies in the industry that have the financial wherewithal. So we were talking about movie things. The only answer for AMC would be bankruptcy, because that even if it was totally allowed, which it would not be, if Cinemark wanted to do a transformative deal to merge with them, Cinemark would be afraid of having those debts on its balance sheet. There's leases and things that these companies use anyway and stuff. So without going through some process to restructure that stuff, they're not going to just do a merger with someone, because there's no one in the industry that's 10 times bigger and has this amazing balance sheet and stuff. But the reason why Southwest probably doesn't mind fighting with Hawaiian the way that they were is because they're very secure in their financial position and they're way bigger and everything. So there are bigger airlines and stuff that could do something with Spirit. So it's not impossible. I don't know how great the strategic value is and stuff. Even the JetBlue stuff, they were intending to change a lot about it, about the way that it operates and everything. So
out of all of the ones we spoke about today, Albertsons is the M&A situation you'd be most interested in.
Yes, but there's a lot of opposition to it. It's very possible that it will never close. But I still like it. Yeah, the stock. I mean, because you kind of have to do the math, but there's some chance that it will close. And what did we say that your gain is there? What, 25% or 20? Does it have the annualized expectations? Okay.
Yes, 24%. Analyzed return, though, because it's a few months, 121%.
Yeah. So the question is, what's the floor on that? I mean, how cheap do you think it will get? You're starting to price in things with the EV to EBITDA and everything that are like, the market's saying, well, their earnings will decline. When you're saying the deal will not happen, there's some percentage of that or whatever. Think of it as like a gated thing that has to pass each of these logical arguments. Obviously, the stock's good if the deal happens. So first, you have to say, okay, the deal has to not happen for this stock to be worth less than this. Then two, their earnings have to go down from what they are now, because, obviously it's not going to stay trading forever at that low a multiple. And I really feel that three, unless the earnings completely collapse, you're also expecting it to have an unusually low multiple, right? Like, it could have the multiple it has now, and earnings could drop a lot, but you're saying that the earnings dropping a lot won't cause the multiple to go up. But actually, a multiple going up 50% from here wouldn't be crazy on low earnings. So you can be wrong. The deal could go through. Earnings could drop a lot and the stock not drop that much, because the multiple could easily go up by 50% and the stock not be absurdly expensive. And there's always a chance that earnings won't decline as much as people think. From earlier podcasts, I think that people are that there's a perception that supermarket earnings were temporary and will come down, and I don't think that that's correct. It's a different kind of industry from other things. There's not a lot of capacity added or taken out. So if you have a one-time inflation of 20 or 30%, their earnings are just going to be 20 or 30% higher in the future. Because it's going to cost 20, 30% more to build a completely new supermarket, and no one's going to do it, So, it was like when we talked about that was the one where we talked about U.S. Steel. And I said, like U.S. Steel, the industry is not good. It's very unpredictable compared to supermarkets, but it has a similar aspect that you have to ask people in the industry, well, how many plants are there out there? What do they cost? What would it cost to build a new one? At some point, you can't really value the business at all that much lower than the cheapest way that someone could expand, because someone in the industry is going to want to expand. So what's the cheapest way they can acquire or build or whatever? And, so like look at things like capacity and stuff. So I think that the supermarket one to me is just, it's not like airlines. I don't see how you could change the supply demand situation all that dramatically. And I think that they're just likely to be better businesses than people might think, based on that, on COVID happening. That I don't think that you should expect that they will go back to earning the same returns on book value and stuff, because that book value is historical stuff. They didn't write up I totally agree that it would be that way if they wrote up the value of their assets and everything to reflect accurate market values today, or to reflect inflation, however you want to put it. But they don't adjust their balance sheet to reflect what the market value of things are now. So when you're seeing that it looks like they had surging revenue and stuff, that's not because they sold 20 to 30% more. What were the increases in COVID to now in terms of revenue at this company?
In 2019, $60.5 billion in revenue. 2023, $77.6 billion. It wasn't.
What do we just have like year-over-year revenue growth for 2020, 2021, 2022?
Right. 3.2%, 11.6%, 3.2%, 8%.
So that's huge.
Uh-huh.
A year where you have 11% or 8%, that happens in the 1970s. It happens in the 2020s, but otherwise it doesn't. There's no growth in this industry at all. People spend less and less of their disposable income over time, so it doesn't even match GDP growth. We're talking about closer to population growth normally. So population growth plus inflation, that's all inflation stuff that you're seeing. And so all I'm saying is in those years where they went up 11% stuff, they didn't write up their assets by like 11% or anything. So what you're seeing is just they selling similar amounts of product at higher prices causes that to happen. And if you look at Village or something, like if they could have margins like they had 10 years ago or something, it would be an incredibly cheap stock. It's just because the margins came down so much, but obviously the sales level is much higher per store in nominal dollars and everything now than it was back then. So I think that it's not, you either have to use these more recent earnings, or you have to actually go to people who know it in the industry and stuff and say, okay, Kroger wants to open a new store. What would it cost to build it? Or Kroger wants to have more stores. Who else can they acquire to get them? Right? Because that Kroger's not going to say, we never want to get bigger. We know how companies work and everything. They're going to want to get bigger. So they're either going to, if you're an oil company, they could either drill for oil or you could buy someone else out and stuff like we're seeing. But you're probably not going to stop and shrink it and everything. So I don't know how far something like Albertsons actually is from just the cheapest way that you can expand in the United States. I don't think it's all that far from it.
Got it. Cool. Well, I want to thank everybody so much for tuning in with Both of Us on the Focused Compounding Podcast. This is the first time you're joining us. Be sure to hit the subscribe button wherever you are listening or watching us here today. If you're interested in learning about our money management services, you could reach out to me at andrew@focusedcompounding.com, or go to our website, focusedcompounding.com, and click that Invest With Us tab to get more information on that. Of course, all the information is down in the description below. I want to thank everybody so much for all the support, and we will see you in the next podcast. Take care.